Good morning. My name is Carl Emerson. I'm Deputy Director at the Institute for Fiscal Studies, and I'm chairing today's event. Thank you very much for joining us. We're doing this webinar from London, where it's currently very sunny and hot. So thanks a lot for tuning in. And the topic of this hour-long webinar is going to be people with low financial wealth. Now, it's well known that lots of families have low levels of liquid wealth that they could dig into were a rainy day event to occur. And we have a new report out today and this webinar to look at this in some more detail. We're going to look at what kinds of families have low wealth, how persistent it is, and we're also going to look at experiences through the pandemic of those who entered it with low levels of wealth. So lots to get into. I want to start by thanking our funders who made this report, this research all possible. In particular, this work was funded by the IFS Retirement Savings Consortium. That comprises Age UK, the Association of British Insurers, the Association of Consulting Actuaries, Canada Life, Interactive Investor, the Investment Association, the Money and Pension Service, and the Pensions and Lifetime Savings Association. Work was also co-funded by the Economic and Social Research Council, and everything that IFS does wouldn't be possible without the funding that we receive from them. So the format for today is we're going to start with two IFS presentations, taking you through the research, what we've found, starting with Bea Boyo and then Thomas Wernham. So they're going to talk for perhaps up to 15 minutes each. We're then going to hand over to Rob Ewell, who is Head of Long-Term Savings Policy at the Association of British Insurers, one of the funders of this research, and we're very pleased that he's going to join us to give his reaction to the findings and some of the implications. And then there'll be 20 minutes or so left for a question and answer session. Jonathan Cribb, the other author of the report, will join for that. And if you want to put questions to us, please use the link in Slido, which should be available in the invitation to this event that you have. Post your questions there, upvote the questions you really want to see answered, and that's what we'll be discussing at the end. So that's all from me. I'll now hand over to Bea, who's going to start with the first presentation.
Thanks very much, Carl. So I'll be talking about who has low savings and how problematic it can be today. In this presentation, I'll focus in particular on the first question of who has low savings, and then I'll provide some evidence on the second before passing on to my colleague Tom, who will describe in more detail the problems caused by having low savings during the pandemic. So we know that it's common in the UK population to have low or no accessible savings. And this is a problem because when people have no accessible savings, they'll struggle to weather an unexpected expense or income shock. It's important for policymakers to understand how they should balance concerns about low accessible savings with other policy concerns, such as low levels of saving into a pension. And so we're trying to answer a question of what the circumstances of those with low financial wealth or savings are, who tends to have them, how persistent they are. In order to investigate this question, we're using the Wealth and Asset Survey, which has been running from 2006. We're using a sample of working age people, so people between 20 and 59. And we'll measure savings at the family level. When I say savings, I'm talking about money held in current accounts, saving accounts, ISAs, stocks and shares. But I'll be excluding pension wealth and LISAs because they're not easily accessible. And what we care about here is people's ability to access this pot of savings in the event of an unexpected expense. And when I say family level, I'm talking about a single person or cohabiting couple, along with any dependent children they might have. Throughout this presentation, I'll be using two different and related indicators of having low savings. One is having savings below £2,000 in 2020 prices, so adjusted for inflation. And this measures households' ability to meet relatively fixed expenses, so the expense if a durable good breaks down, for example. The second related indicator is whether people have less than a month's disposable income in savings. And this captures expenses that might be more closely tied to their previous income. So things like rent or mortgage payments that you'd expect to be related to income. So to start off with, I'll talk about who has low savings. This is relatively common. Around 40% of the working age UK population have less than £2,000 saved or less than a month's net disposable income. But as you might expect, this differs by various characteristics, one of which is income. So in this graph, on the x-axis, I'm showing you each decile of the income distribution, so each tenth. And on the y-axis, there's the proportion of people who have one of these measures of low savings. Here I show you the proportion of people in each tenth of the income distribution with less than £2,000 saved. As you can see, and as we might expect, this is strongly related to income. So those in the lowest tenth of the income distribution, 7 in 10 of these people have less than £2,000 saved. And then in the 10th decile of the income distribution, that's less than 10% who have less than £2,000 saved. But we might expect people in the lowest income to have no savings. But what's really notable here is that many of those in the middle of the income distribution continue to have less than £2,000 saved. So more than 40% of those in the middle of the income distribution have no savings. A very similar picture is true when we look at people who have less than a month's net income saved. As you might expect, the gradient is somewhat less steep, and that's because the threshold for having less than a month's net income is rising as we rise up the income distribution. So it's still the case that lots of people in the middle of the income distribution have less than a month's net income saved. And that's potentially worrying because these people will receive lower levels of insurance in the event of a job loss from means-tested working age benefits. There are also other characteristics that are related to being more likely to have low savings. So in the Wealth and Assets Survey, people are asked 3 questions which get at their level of financial literacy. One gets at whether they can understand the bank statements, one is about inflation, and one's about interest rates. And we can look at the number of these questions they manage to answer correctly and look at the proportion of people in each group who have low savings. Here I show you the proportion of people in each group who have less than £2,000 saved. Almost 70% of people who can't answer any of these questions correctly have less than £2,000 saved. And that compares to less than 30% of those who answer all 3 questions correctly. Again, the picture is similar when we look at people who have less than a month's net income saved. So almost 70% of those who don't answer any of the questions have less than a month's net income saved. And around 30% of those who answer all 3 questions correctly have less than a month's net income saved. And this potentially suggests that boosting levels of financial literacy in the population might be one way in which policymakers might be able to boost levels of accessible savings. But of course, it's the case that having high levels of financial literacy will be correlated with other circumstances such as education, income, and age. And so what we do is we control for all of these factors to get a sense of whether financial literacy, as well as other characteristics, are still related to having low savings. We do a regression analysis to do this and control for other factors. Income continues to be statistically significantly associated with the likelihood of having low savings. So those in the top 10% of the income distribution are 33 percentage points less likely than those in the bottom 10% have less than £2,000 saved, holding other factors constant. Financial literacy also continues to be associated with having low savings over and above the effective characteristics like age and income. So those who answer questions on financial literacy accurately are 8 percentage points less likely than those who answer no questions accurately to have less than £2,000 saved. Age is also related to having low savings, so older people are less likely than younger people to have low savings. And family type is also related to having low savings. Couples without children are less likely than couples with children to have less than £2,000 put away. This has been a snapshot picture so far, but the proportion of working age adults who have low savings over time has been changing. Here I'm going to show you the proportion of working age adults who have one of these measures of low savings over time, so from 2010 to 2019. As you can see, the proportion of those who have under £2,000 saved slightly rose between 2010 and 2012, but has been falling since 2012, reaching about 40% in 2019. The picture is similar when we look at the proportion of people who have less than a month's net income saved. Again, there's a fall from 2012 onwards. And as well as this fall taking place, the composition of people with low savings has been changing. So those with lower incomes, those who are younger, and those who rent rather than own their homes are more likely to have seen the proportion with low savings fall, meaning that the composition of people with low savings is becoming relatively less vulnerable over time. These more vulnerable groups are more likely to have had a financial safety net. But of course, our data ends at the end of 2019, and several important events have happened since then that we might expect to have significant effects on the proportion of people with low savings and their composition. Most obviously, the COVID-19 pandemic had significant effects on the proportion of people with low savings in the population. Using other data sources, surveys have documented that the COVID-19 pandemic saw significant increases in aggregate saving during the period. This is because of what's been dubbed forced saving, where consumption possibilities were shut down across the economy, so more households were able to put money away in savings that they would otherwise have spent on these things. The Bank of England finds that this is concentrated in high-income households, so they find that 42% of higher-income households reported having saved more during the pandemic, and only 23% of lower-income households. And this might indicate that, while perhaps savings will have risen since 2019, the effect that I talked about in the last slide, where the composition is becoming less financially vulnerable, might change. It's also, of course, the case that the pandemic led many people to draw down on their savings, and my colleague Tom will talk more about that in his presentation. The cost of living crisis should also have had a large effect on the proportion of people with low savings. So the Financial Conduct Authority has documented that this has increased the proportion of adults in financial difficulty in these years, which might expect to increase the proportion of people with low savings and to increase the vulnerability of the composition of this group. Finally, in terms of characterising this population of people with low savings, we can wonder about how persistent having low savings tends to be. So there's one argument, which is that having low savings might be more likely to be a snapshot state. Perhaps you've just paid down money after meeting an unexpected expense, or you've just entered the labour market and you're likely to build up more savings over time as you work for longer. But what we find is we use the ability of the Wealth and Asset Survey to link people over time and look at how many waves they report having low savings in. Of those with low savings between 2018 and 20, we can look at how many waves they reported having low savings in. So those who reported having low savings only in 2018 to 20, those who had them in 2018 to 20 and either the last time they were questioned, so in 2016 to 18, or the time before that in 2014 to 16. And then those who had low savings in all three waves they were looked at, so 2018 to 20, 2016 to 18, and 2014 to 16. And here I show you the proportion of people with less than £2,000 saved in each group. As you can see, it's most common by far to have low savings in all three waves. 70% of the people with low savings in 2018 to 20 had persistently had low savings, and less than 10% had only had low savings in that one-off period. The picture is again similar when we look at people who had less than a month's net income saved. That seems to be a slightly less persistent characteristic, but it's still the case that only about 10% of people only had less than a month's net income saved in that single wave. So now I'll talk a little bit about the second question, exactly how problematic it is and for whom to have low savings. We care less about savings in themselves than their function as an insurance mechanism, allowing households to weather unexpected shocks without falling into serious financial difficulties. In the Wealth and Asset Survey, households are asked how they would meet an unexpected expense of a month's income, asking them to choose from a list of different ways in which they'd meet this expense. We can split people into those who have a month's income saved or more and people who have less than a month's income saved, and break down how they say they would meet this unexpected expense. So first, there's people who say that they would meet the expense through using money from their current account or from using existing savings or investments. As you can see, more than 80% of people with more than a month's income saved say that they would use these mechanisms, and that's only about a quarter of people with lower savings. There are other insurance mechanisms that people might have access to. So about 23% of people with low savings say they would borrow the money, and 28% say they'd get help from family or friends. But most concerningly, almost a fifth of people with less than a month's income saved say they simply wouldn't be able to find the money for this kind of expense. We can break this kind of question down across the income distribution. So here I'm going to show you a graph similar to what I showed you earlier on in this presentation, with the proportion of people in each income decile who have less than a month's income saved. But here I'm breaking it down by how people say they would meet an expense for a month's income. Some people won't ask this question, and a further proportion of people say that they would meet it from their current account or savings. As you can see, using help from family or friends or borrowing the money is relatively constant across the income distribution. But a significant proportion of people, even in higher income deciles, say that they wouldn't be able to find the money from this expense. As I've described before, people at the very bottom of the income distribution will receive more insurance from state benefits if they lose their job or face high expenses. And this is less the case for people in the middle of the income distribution. We might also think there's less of a case for telling people on the very lowest incomes to save the marginal pound that they receive, rather than directing it towards other financial needs. So that those at the very top of the income distribution might be much more able to cut back on discretionary expenses. So we can look only at those in the middle 60% of the income distribution, so cutting out the bottom 20% and top 20%. This represents 8.8 million people who have less than a month's income saved. And 1 million of these people say that they've been unable to meet an unexpected expense, even using these alternative insurance mechanisms. And this is really especially concerning and highlights people's potential vulnerability to financial shocks. So I've shown that having low levels of saving is most common among people who are lower income, younger, and who have other characteristics such as lower levels of education. But it's not uncommon even among people who don't fall into these brackets. And in particular, large proportions of people in the middle of the income distribution have low levels of saving. Interestingly, especially for policymakers, more financially literate people are less likely to have low levels of savings, and that's even controlling for other factors. Finally, as I've just said, many of those with low savings have other mechanisms through which they might be able to deal with an economic shock. But these mechanisms might not be optimal, and some would be completely unable to access other forms of support. I'll now pass on to my colleague Tom Wernham, who will talk in more detail about these other mechanisms.
Thank you very much, Bea. So hello everyone, I'm Tom, and I'm going to be talking about some evidence we can see from the pandemic on just how important the role of savings was in protecting people from hardship. So we've just seen that there is considerable variation in the amount of savings held by different groups. And we've also seen that many with low savings would struggle to meet one type of economic shock, and that's an unexpected expense. Well, the pandemic provides us with the opportunity to examine another type of economic shock, and that's loss of income. And this was a shock that was both widespread and unexpected, as many people were very quickly furloughed or otherwise lost work. So what we're going to do in this presentation is provide evidence to measure the importance of savings during the pandemic in protecting people from falling into financial hardship. So just to very quickly tell you about the data we're using, we're going to be using the UK Household Longitudinal Study, known as Understanding Society, and this is another survey which allows us to track people over time. So during the pandemic, people were asked a range of questions about their experiences, such as whether they were on furlough or had stopped work, whether they were falling into arrears on their bills, and also what actions they had taken to deal with any losses to earnings that they experienced. And pre-pandemic, in many years pre-pandemic, the survey would ask people a variety of different questions about their characteristics, and crucially, that includes savings. So we're going to focus on working age people's experiences, just like Bea did, in both April and May 2020, so right at the beginning of the pandemic. So how can we measure the effect of low savings on financial distress? Well, as I said, we're going to look at the beginning of the pandemic, and we're going to look at the relationship between having low or no savings before the pandemic started and falling into arrears on bills. We think arrears on bills is a sign of quite significant financial distress. It's quite severe if you're unable to pay your gas or electricity bills. And it's also quite simple to measure in the survey data because people report it. And we're going to focus on three groups who were in paid work at the beginning of 2020, but who lost work due to COVID and lockdown. So those who became furloughed in April 2020, those who became self-employed, but those who had been self-employed but lost all work in April, and those who became unemployed by April. And then once we've looked at the role of savings in April, we will then repeat the exercise, but look a month on in May. And just to quickly mention the types of savings we're looking at, the survey asked questions about a range of different types of savings listed here. It's not quite as extensive as the data that Bea was using. For example, we don't have current account information, quite crucially, but it's still a wide range of different types of savings accounts. And we sum across all these different types of savings and calculate the total household savings. So let's just have a quick look at what these data look like. So we can see that many people had low or no savings before the pandemic, just as Bea found in her data. So around 29% of the people who we're looking at who were furloughed or who otherwise lost work and therefore lost income had absolutely no savings reported of the types that we've just seen, and about 57% had some savings but less than a month's income worth. And we can see the proportions are also similar for the other group that we're looking at. So low savings and no savings even are both widespread throughout the population. And then if we just look at the measure of financial distress we're using, being in arrears on bills, well, before the pandemic, around just over 6% of people who would go on to lose work were behind on their bills, actually slightly less than the proportion of people who didn't fall out of work. But when we then look in April 2020 at the proportion behind on their bills, we can see a really big and drastic increase. So the proportion of people who lost work and who therefore lost income, who were behind on their bills, well, it over doubled. And given, as we've just seen, that many of these people had low or no savings, we might be concerned that this is a shock they would struggle to deal with. And this just shows that looking at this particular group, they are a group who really did suffer a significant economic shock. So what's going to be our method for measuring the effect of having low or no savings? So what we're going to do is compare the likelihood of falling behind on bills for those who had no savings and those who had low savings worth less than a month's income against a baseline group who had at least a month's income worth of savings. But we can't just straightforwardly compare these groups because, of course, people who have higher savings and lower savings will differ in lots of other relevant ways, potentially age or income, education, how many children they have, which might also affect their resilience to economic shocks and their ability to withstand loss of income, which isn't directly related to savings as such, it's just correlated with it. So what we're going to do is conduct a regression analysis to control for other relevant factors, the same sort of analysis that we briefly mentioned in her presentation. So to be more specific, we're going to control for the range of factors that I've listed here on the screen. And essentially what this analysis allows us to do is to compare like with like. So to compare people who have higher amounts of savings and lower amounts of savings, but who are otherwise similar in with respect to these characteristics, and see how their outcomes, their risk of falling into distress differs. And this helps us to measure something closer to the causal effect of having low or no savings on the risk of falling behind on bills. So let's now have a look at the results of this analysis. So what I'm going to do here is plot the effect of low savings on the probability of falling behind on bills in April. And it's all going to be relative to this group of people who have at least a month's worth of savings. So I'm going to start by looking at the group who had no savings at all. And what we can see from this bar on the left here is that they were 6.3 percentage points more likely to fall behind on bills than those who had at least a month's worth of savings. And if we remember just the overall proportions of people behind on bills, that's actually a really huge effect. So people's fates, to quite a significant extent, predetermined by how much savings they went into the pandemic with. And quite interestingly, it's the self-employed for whom we see the biggest effect, a huge effect of 15.5 percentage points. And one reason that might be is that the support that was made available to self-employed people, self-employed income support scheme, didn't start paying out straight away. In fact, I think it was towards the end of April that people started receiving, towards the end of May that people started receiving payments. So many people in this group will have lacked support during this period and really relied on savings. So if they didn't have savings, that would have put them in a vulnerable position. And then for the other groups, we see slightly smaller effects. I've dotted the bars out because these estimates aren't statistically significant at the 5% level. What that means is we essentially just need to be much more cautious about interpreting these results. In particular, the group who lost employment, there's a very small sample, so it's difficult to get results we're confident in, but it does look like there was a significant role of savings in protecting these people as well. And then if we look at the impact of having some savings but less than a month's income compared to people who had more, well, we can see that the impact is much lower. So what this essentially tells us is that it's really having no savings at all that put you at risk. Having a small pot did seem to provide some level of protection right at the beginning. Now, if we then turn to look at the results in May, so people who had fallen out of work by May and how likely they were to be in financial distress, well, we can see even bigger effects of having no or low savings, but crucially, those bigger effects are coming through for the group who have some savings, but less than a month's income. And we think this might be because if you have just a small amount of savings, that's able to perhaps tide you over right at the beginning of the period, but by May, perhaps those savings had been exhausted, and so even people who went into the pandemic with small pots of savings were starting to struggle if they hadn't yet received support. And many of these self-employed people in particular still would not have received support from the government. The overall effect is also bigger. It only just fails the threshold of statistical significance that I'm using here, but it does seem that there's a bigger effect of having small pots of savings slightly later on in the pandemic. So now let's have a think about how those with low or no savings might have dealt with losing income, given they didn't have many savings to draw on. So the survey that we're using included questions which allows us to measure this directly. In particular, respondents were asked how they dealt with a loss of earnings, and they could give answers such as reducing spending, borrowing from family or friends, borrowing from a bank or credit card, or getting more paid work, or having other people in the household get more different paid work, so getting a different job, for example. And so we looked at how having low or no savings affected the likelihood of taking these actions. So essentially the same sort of analysis as just now, but with a different outcome of taking these sorts of actions. So let me show the effects on these different sorts of actions. So instead of looking at different groups of people who lost work on the x-axis, now I'm looking at different actions they might have taken. And what we can see is that we have notable estimates for increases in people being more likely to reduce spending or borrow from family or friends if they had no savings. And then if we look at the group who had some savings but less than a month's income, and relative to those who had more savings, well, we can actually see that they were a little bit more likely to borrow from a bank or a credit card instead, but less likely to take these other two options. So one possible explanation for this, and it's only speculation, is that those who had a small amount of savings were deemed more creditworthy by formal financial institutions and banks, so they were better able to access formal credit, whereas those who had no savings at all weren't able to rely on those sorts of mechanisms, so had to rely on more informal mechanisms or just simply reducing spending instead. And then we also looked at whether people got different paid work. Very tiny effects here. It's probably in reality 0 or close to 0. And that's unsurprising given the huge disruption to the labour market that the pandemic caused, particularly right at the beginning. If someone unexpectedly lost work in that period, it would have been extremely difficult for them to simply find more work straight away. So just to wrap up, we've seen that amongst those who lost work during the pandemic, those with more savings were much more protected from falling into financial hardship in the first couple of months. And savings were most important for the self-employed, many of whom received limited support from government early on. And this suggests that savings did provide a valuable means of self-insurance for households. And I don't think people are going to be surprised that people with more savings were able to keep up with their bills better than those who had fewer. But I think what's really striking from these findings is the size of the effects and just how much more likely people were, if they didn't have savings, to fall behind on their bills and fall into financial difficulty. And then we also see that households used other means of responding to lost income, such as reducing spending or accessing formal or informal credit as a substitute for savings. So thank you very much. That's all from me. And now I'm going to hand over to Rob.
Hello, thanks very much, Tom and Bea, and thanks to IFS for the invitation to respond today. I'm from the Association of British Insurers. We're one of the funders, and we've been involved in the IFS Retirement Savings Consortium for as long as I've been at the ABI, which is 10 or more years. And we're continuing into the next round, and we know there's lots more valuable insights to come. Particularly pleased IFS is looking at this subject. It's important for people in pensions, investments, long-term savings like me to understand more about short-term savings, what people have and haven't got, and who they are, whether they're our customers or not. And the market is changing with increasing overlaps between short and long-term savings. I'm just going to pick out a few key things that interested me and implications for industry and policymakers and potentially for further research. One encouraging thing overall, that proportion of people with low savings was falling throughout the 2010s, even with lousy interest rates. So that's one thing to look out for in future. How price sensitive are the people who don't save? We're already seeing a big spike in people using cash ISAs recently. There's real competition for cash savings, but it's probably not those persistent non-savers. And there are other economic changes, obviously. So what impact is that going to have on who doesn't save? I was interested and worried in how precarious the self-employed are. Again, a previous piece of research by the IFS for this consortium was on the self-employed. What I liked about that is that it said we don't know why the self-employed savings levels have fallen so much. None of the obvious explanations really stacked up. So that's concerning finding, but something to keep an eye on. It definitely relevant to policymakers. However, the self-employed can save, need to be helped to do so. Third, financial literacy finding. It's depressing in a way, but it's encouraging because it can be addressed. I don't want to overstate the importance of financial literacy, but as you saw for yourselves, it is important. Controlling for other factors, it still makes a difference. So just to go into that in a bit more detail, the questions asking about financial literacy are maths questions, really. We need to recognise the different but overlapping concepts around numeracy, financial literacy, which is about skills and knowledge, financial capability, which is partly about attitudes and confidence, and financial inclusion. And they're all inextricably linked, but they all play a part in helping people to make financial decisions. And the industry and policymakers have a role in addressing each of those, as well as education sector more widely. At the ABI, we've got partnerships to address these with Plain Numbers, who help firms communicate numbers clearly, with the FT's Financial Literacy and Inclusion campaign, the Centre for Financial Capability, which looks at financial education in schools, as well as work with the Money and Pension Service. But there's a lot more to be done across the economy to help get people comfortable with numbers and with money and financial decisions. Wider policy decisions, the obvious one is make it easy to save. Nest and their backers and partners and Step Change before them have really shifted the debate on liquid savings alongside pensions. If you're not familiar with that research, it's enrolling people into cash savings in the workplace. What difference does it make if you opt in or opt out, and the impact on pension savings? And there was a global report by BlackRock out this week, which cited Nest Insight's work, among others, really majored on emergency savings not cannibalizing retirement savings in their work. That's interesting to hear, but I've never heard it in those terms before. I've never heard it expressed as a commercial concern that people might be saving a few pounds through the workplace and really it should be in a pension. But there is a trade-off, and it's really helpful to explore it. So we need to make it easy to save, and the workplace is a very good place to do that. There could be a concern that people move from job to job, acquiring little bits of emergency saving and never a pension. But that can be resolved through policy design, and we can pick that up in questions. Tech will also help as well, as long as people can see across their finances at the same time, and there are policy developments in that direction as well. Another way to get people saving, make it easier, is the Help to Save scheme. That is a challenge for workplace savings because some people would be better off with Help to Save. It's very topical because the government's consulting now on the future of Help to Save. Deadline's next week. Personal view, it makes sense if any workplace savings scheme put all eligible people into Help to Save, and they can opt out if they want. Or at least these policies across government, across DWP and Treasury, learn from each other and are done in collaboration, also bearing in mind housing costs, which I feel loom large in this debate. That's all from me. Thanks again to IFS, and there's plenty to pick up in questions.
Thank you very much, Rob. Thank you very much, Tom, and to Bea. Also joining us now for the question and answer session is Jonathan Cribb, who's also an author of the report that we're talking about today. And I'm going to start with you, Jonathan, with the first question here. Actually, two of the questions. There's two questions which relate to people's characteristics and how that's associated with having low wealth. The first is the most popular question, which is something I think is pretty interesting, actually, that obviously we see this gradient by income. It's low income households who are more likely to have low wealth, but actually it's still the case that some households with pretty high income, pretty well up the income distribution, also have low wealth. And I wonder if we have any insights on why that might be. And in addition, somebody's asking about whether we've looked at what role disability might be playing for some individuals, and whether we consider that as part of this report. So Jonathan, I wonder if you could touch on those.
Yeah, I think I can touch on three reasons I can think of for the fact that even among high income households, a not trivial fraction of people have low levels of financial wealth. Two, which I'll go through quite quickly, and one more detail. The first two are kind of fairly simple points. You know, there is a range of people who are high income. Some will be there kind of temporarily high income. They might have a particularly good year in self-employment, have a relatively recent pay rise or something like that, which means that they look, and it takes time for them to kind of build up their savings to look more like a higher income person. So there's always going to be a bit of movement about the income distribution, and that's going to kind of make it look like this to some extent. Secondly, there'll be some people who do things like just saved up for a deposit on a house and don't have very much money. Maybe they have a little bit left over, but maybe that's a small number. I think the interesting one is the fact that there's evidence from the UK, from a lot of developed nations, that there is a group of people that some economists in the States have called the wealthy hand to mouth. These are high income, actually high wealth in terms of private pension or housing assets, who have relatively little financial wealth, basically because they can get better returns on wealth if they lock it away for a bit longer in more liquid forms. And if you've got a very high income, you can generally, in the face of a shock, cut back on discretionary expenditure in a way that isn't particularly difficult for people to do. And there is evidence that that's not a trivial, that's a significant aspect of some high income, high wealth people. On the disability factor, we didn't look in specific terms at people with disabilities, although they are likely to have lower rates of saving in general, partly because of the correlates that we know about people with disabilities. So lower income people, out of work, people living more likely to live in social housing. Some of these aspects are all more pointing towards people with disabilities having lower savings, but we didn't examine it specifically.
Okay, thank you, Jonathan. Bea, so there's a couple of questions really, I think, getting at how things might have changed since. I know you touched on it a bit in your presentation, but there's one thinking about, well, we've got a very high inflation over recent months, cost of living crisis. That's clearly going to have a lot of effects on different households, potentially adverse ones. Interest rate rises now working their way through. I wonder if you could sort of go through how you might think things have changed since the pandemic, and perhaps maybe also what lessons we might learn from that decade, where, as Rob picked up, perhaps surprisingly, we saw good news despite pretty weak economic performance in terms of increasing numbers of households getting over the thresholds we looked at.
Yeah. So I think one kind of takeaway from the previous decade's trends is how much the kind of composition of people with low savings is becoming less vulnerable in certain ways, as well as the numbers are kind of falling. And I think that one thing that we'll see in the new data after seeing kind of the cost of living crisis as well as COVID is that, perhaps the proportion of people with low savings will have risen or fallen. They've got potentially offsetting effects, but we should expect to see the composition of people with low savings become more vulnerable, since what we know about the kind of cost of living crisis is that it's already more vulnerable households who are more likely to be drawing down on their savings and in financial difficulties. And we know that while COVID-19 pushed up savings in aggregate, it tended to be higher income households who saw savings rise by more, while lower income households are more likely to have to draw down. So a kind of reversal of the trends in composition that we saw over the last decade, and potentially a reversal of the fall in the proportion of people with low savings, I think is what we might expect.
Thank you. So there's a question from Louise about the 5-week wait in universal credit, which I don't think we did look at all in this analysis, but I can tell you that colleagues are looking at that at the moment and are using some detailed data on people's spending patterns, and are looking precisely at the question of what happens to people's spending patterns in that period between initially applying for universal credit, where quite likely they've experienced some adverse income shock, and the 5-week period up until you actually start to receive universal credit, and looking at how households cope through that period and what if we can see any effects on their budgeting. So that will be coming out in due course. You'll have to wait for that one, I'm afraid, but it is on our radar. There is something that we're looking at. I want to turn now to the question about the self-employed. And Tom, I think I was very struck when I saw your presentation about the extent to which the self-employed were falling behind on bills, the extent to which that was particularly true if they entered the pandemic with low savings. And I guess there's sort of two questions I have there is sort of one, or two issues I think this raises. One, it highlights the extent to which the self-employed are vulnerable in the sense to which their incomes are much more volatile than those of employees. And I think the second issue is that despite that vulnerability, despite the fact that their incomes are less certain, there does seem to be a core of self-employed people who don't have liquid savings, who don't have kind of that form of insurance against those kind of shocks. And I guess the question is whether there's more we should be doing to help the self-employed build up those pots, whether is this a problem that occurred during the pandemic with actually the state support, and state support we know for the self-employed for some was relatively generous, but for others was really quite patchy. So I'd be interested in your thoughts on that.
Yeah, I think it's definitely true that it's a challenge to try and raise savings levels amongst the self-employed. In terms of the data we looked at, there is partly a pandemic specific story as well. Just as you said, the SICE scheme was very patchy. There were lots of people who, just because they failed various cutoffs in terms of timing or amount of income they were receiving, actually just received no support at all at any time. Similarly, there are some other people who perhaps received support even though they were still actually bringing in income. So the scheme was very patchy, not very well targeted, and it also sort of came in late. Payments didn't start arriving until May. I think it might have been late May as well, which partly drives some of the results we've seen. So yeah, in the pandemic in particular, the self-employed, or some of the self-employed were really hard hit by the fact that they might not have received this support, and they also, many of them went into it with low savings. And the more broad challenge that highlights is just going forward. Are there ways to encourage self-employed to save more, and also potentially, if we do have a really big crisis in the future similar to the pandemic, and other schemes which support the self-employed also be designed a bit better, so that their fates aren't so predetermined by how much of their own resources they can draw on to support themselves.
Yeah, I certainly agree, and particularly on that last point, that perhaps one lesson of the pandemic is that government needs to think through what data, what information it holds, what could it hold, how could it respond better, more nimbly next time. That might be one of the key lessons we could take from the pandemic, so that the next time we have some kind of shock that does require government support, that we can have that as well designed as possible. It's pretty clear the Treasury were operating with very limited information, particularly at the start of the pandemic. And Rob, turning to you on the self-employed, you mentioned in your response the BlackRock work, looking at workplaces, looking at how interventions there perhaps can help employees build up liquid saving. I guess for the self-employed, we often focus on the fact that their pension saving seems to have been collapsing over the last couple of decades. We always knew that they had these volatile incomes. We now know, of course, that they have low liquid saving, and indeed that seems to be caused quite a lot of problems for them. I wonder if there's any lessons from that research or any policy implications that we can see that might have some implications for the self-employed if things are working for some employees. Are there any read across, or is it just difficult because, you know, absent an employer, these interventions just can't work for them?
Yeah, the employer is a major help. I mentioned that tech developments and this new trend in embedded finance, which is a fancy word of giving people products where they already are. And in a way, automatic enrollment is embedded finance, just happens through the workplace. Much harder to do that with the self-employed. We in governments have looked at ways that people can be prompted to save, like through the self-assessment process. So loads of people will have seen that, but it is a pop-up nudge to say, have you saved into a pension? You could do something similar for cash savings. Will it shift the dial? I think we'll have to wait and see. The BlackRock and Nest Insight research really shows the power of inertia and defaults. If you can do that, help save. I don't have the data to hand. I think it's been moderately successful, but anything like that tends to have lower take-up than you might expect. I think it's making access as easy as possible. I can comment on a couple of the other questions if that would help.
Yes, please.
The question about higher income people, that one of the things that struck me that I didn't mention was about family structure, but single people, whether they've got children or not, are less likely to have savings. And there could be a few things in there to unpack. Might be partly about attitudes. It could be about housing costs. Either people are saving up if they're single, or living hand to mouth if they're single parents. And multi-generation households, thought that was interesting. Adults living with parents more likely than their peers who are homeowners, and that's likely to be the fact that homeowner peers are paying off big mortgages. So housing cost runs throughout. To reference another previous piece of IFS research, one of the key drivers for people opting out of automatic enrolment, or correlated, not necessarily a cause, is that your partner does. If your partner's opted out, you're more likely to, and we don't know why. I don't think we really know enough about financial decision making within households. And briefly on disability, there was a report by Money and Mental Health recently called The Pensions Maze, and that looked at some big data sources about composite variables, probably got the terminology wrong, that try and define mental health, and they show how much worse people's pension savings are, and there are various reasons for that, as Jonathan set out.
Thank you. I mean, Tom, I mean, on the question of people saying that they would be able to get help from family or friends, I guess when I see that, I think, well, you know, I guess if somebody's got low wealth and they know that their parents, for example, are a high wealth family, and they know their parents could be relied on to help them out if they have a bad shock, that's in some ways a good news story. They don't need to have any liquid savings. It's all fine. But of course, the concern is people might say, oh, well, if I need to find £1,000 for an unexpected expense, I'd go to my friends or family. And then if that rainy day hits, what happens if perhaps their friends or family can't help them out? Perhaps if it's a false hope. I don't know if there's anything we looked at in the data about that group who said that that's how they would meet that expense, and the extent to which that really happened, or perhaps whether they weren't as fortunate to be able to draw on that sort of funds when a rainy day struck. I
mean, one thing that I could mention in response to that is that in other IFS work that touched on with David Zurich, we found that there don't seem to be kind of strong responses of financial transfers to people experiencing kind of negative events such as unemployment or a shock to their income. So potentially these transfers aren't so likely to actually take place when people face these negative events. It's more the case that people feel they can rely on them, and perhaps that's actually really quite risky because they won't be able to.
And then, yeah, I would add, I mean, in terms of what we saw during the pandemic, we did see some evidence that this was happening. There was about 3.3 people with no savings, about 3.3% more likely to borrow from family or friends, people who had large amounts of savings. So it does seem there is some kind of substitution mechanism there, and that's good if people can rely on that. But I mean, I suppose one risk, particularly with the pandemic, was that the shock was so widespread. It might be that when people fell into difficulties, their friends and family also fell into difficulties at the same time. So in terms of that very specific scenario, that may have limited some people's abilities to do that. So, but yeah, I mean, if it is a mechanism that people know that they can draw on with some confidence, then maybe, yeah, it's reasonable that they have decided not to save so much themselves. But yeah, it's only going to be applicable to some people, and there's going to be lots of people who don't have that mechanism available.
Yeah. Thank you. And Jonathan, this might be slightly unfair. The top-rated question at the moment now is looking at other countries. I guess, is the UK an outlier in terms of having relatively large numbers of working-age adults who don't have much in the way of savings, or is this a problem that other countries are trying to tackle too?
Yeah. So we didn't look at this specifically. It was very much focused on the UK. Previous work, scholarly work, has focused on this issue on a range of large industrialized nations. I think that, well, I actually just looked it up. It showed that using similar kind of metrics, they looked at whether you had half of a month's income, not a whole month's income. The UK looked pretty similar to Canada, America, and Germany, slightly higher levels of low savings than France and Australia and Italy. Honestly, so I think, it means that the UK doesn't, at least on those data, and those were in the early 2010s, wasn't standing out as completely different to other rich nations. In terms of understanding whether there's specific, using that to understand whether there are specific drivers, I think that's very difficult. There are, these countries are actually quite different in wealth, lots of different institutional differences, housing market differences, pension differences. I think it'd be quite hard to do.
Yeah. Indeed, there's a few questions. I think really looking at some of the trade-offs. So it's all very, I guess, in other work, we often highlight individuals who look like they're at risk of undersaving for retirement, and we sort of talk about, well, need to boost their retirement saving. Here we're talking about households with low levels of financial assets, that people are raising questions on the online forum saying, well, what about people who've got debts? Should they not be paying them off first? Or what about the fact that people might be trying to get on the housing ladder? I wonder, Jonathan, or if indeed others, any thoughts about, is it a case of ordering these priorities for households? Is it the case of saying, well, actually, if you save in one form, it could help with some of the other problems? What should the approach be here?
My instinct on this is, in general, that particularly for lower income people, the focus should be on paying down debt, particularly, or at least moving debt into very, very low interest forms, whether that means moving across to credit cards, on balance transfers, so you have 0% if that, to the extent those still exist. So in general, the amount that you're going to pay on the interest you're going to pay on debt is going to massively exceed what you can get on savings, and so that's a focus. I think that in terms of savings in a pension versus kind of savings in liquid forms, I think that there is a good case that people should be trying to have some form of rainy day fund if they've got it, and then have most of their wealth in private pensions, because that's what people want to do. They want to push, most people want to push savings back so that we can, they can have a more comfortable retirement. Clearly, the amount that will be, everyone's going to be a bit different, but broadly, it does seem that some form of buffer stock is going to be valuable. You're not going to be able to self-insure against every shock, but it's good to be able to not be too vulnerable to even small shocks, and that a little bit of savings can help you there. I don't know if Rob has particular thoughts there as well.
Yeah, these are difficult trade-offs for individuals. Financial services policy, pensions, savings can help a bit, but it can only go so far. Yes, there will often be rational reasons not to save, like paying down debt first, trade-offs between liquid savings and pensions, but also saving for a home as well. I would have thought those people who are saving on 0.1% in the 2010s were probably doing so to buy a home, not just to build up an emergency buffer. It's partly about there's a national financial capability strategy, starts in schools, get people to the right support when they need it throughout their lives. We're thankful we have people like Martin Lewis who have very simple rules of thumb about how much of an emergency buffer to build up and about paying down your debts first. But there are difficult decisions that everyone has to make. One of the questions in there is there a wider question about welfare support? Yes, there is. If some people do not have enough money to save, and income being a factor comes through strongly in the research.
Thank you, Rob. And I guess just to stay finally on that, I guess it's also true that if you build up a buffer stock, not everybody's going to experience that rainy day. Hopefully, very, very few will. And of course, for those people who build up that buffer stock and then don't have that rainy day, those savings could be then put forwards perhaps towards a deposit on a house or a pension or some other form. So one advantage of building up that liquid stock of wealth is that hopefully the unexpected expense or drop in income won't materialize, and then those funds could be at some point diverted towards some other use. So thank you very much for all those questions, everybody. I hope you all agree it was a very, very interesting session. Particular thanks to Bea and Tom for the 2 presentations they gave, to Rob for his response from the ABI's perspective, and to Jonathan, also a co-author of the report, and for his responses today. Thank you very much for joining, everybody, and I hope to see you all sometime soon.